Crypto exit strategy confirmed. Hey guys, welcome back to Stacking Stocks, and thanks for joining us today. As usual, we're bringing you exciting and informative content. Are you elated to tune in today? Well, we endeavor to give you an edge-of-the-seat experience. Can you guess today's topic? Well, there's no need to be anxious. In today's session, we'll discuss the crypto exit strategies. When do you know it's time to quit? How do you exit from the crypto market? We know you're eager to get the answers, so sit back and relax. Before we get into today's headlines, let's quickly recap our last session. Don't worry if you missed the session, we'll give you a brief insight. In our previous session, we assessed the key metrics where Binance Smart Chain has been dominant. What's happening on the Binance Smart Chain? For more details, please check out our previous video on our wall. You don't want to miss this. Let's now fix our focus on today's topic. Is there a good exit strategy for the crypto market? These turbulent times require you to prepare for any eventuality. How can you ensure that you preserve most of the amount of money you invested? Is it necessary to have an exit strategy? If you're a crypto enthusiast and trader, you must have asked yourself such questions at one point. Like any other market, the crypto markets move in waves of upside momentum or bull market and downside momentum or bear market. Have you experienced any of these waves in the crypto market? How do you get through the waves? One clear thing is that entering and exiting at the right moment can prove to be lucrative. But where are we at with the crypto market currently? Let's find out. In the current cycle, it's difficult to call the highest and lowest point. Maybe we're currently in the crypto bull market, but do you know when it's going to end? Nobody knows when and how it'll happen, but somehow it'll happen. But when it happens, will you be prepared to handle the bear market? It's necessary to investigate every possible exit strategy. Do you know that moment? Do you know what it means not to have an exit strategy? It means that you may have to take premature profits or unwillingly become an altcoin holder. Why suffer losses when you could have avoided them? Before we give you viable exit strategies, we've got to understand what it means to have an exit strategy. Technically, it's a contingency plan put in place to liquidate a financial assets position. In a nutshell, it's a plan to sell off your financial assets. What will you do in case of a sudden breakdown? The goal of the contingency plan is to help you limit losses if there is a breakdown. Since we're talking about objectives, why do you think you need an exit strategy? You can get huge losses when you hold a specific coin for too long or due to greed, even when the price is way above the entry price. Do you know what makes that possible? Let's have a practical example. Imagine a situation whereby you buy a cryptocurrency this month, and a couple of weeks or months later, the value increases by 20%. Ideally, you'll think that the best option is to sell your holdings. On the other hand, your friends who also bought the cryptocurrency decided to keep their coin holdings. What happens if the coin shoots to the moon? You'll be the only one missing out. FOMO, fear of missing out, is a mistake many investors make in cryptocurrency trading. Let's analyze another scenario. After jovially looking at your investment portfolio, you decide that the best move is to hold the coin for another couple of months, let's say 2 months. However, within these 2 months, things go south, and there's a massive reduction of about 50%. That means your investment is worth less than the entry price. What will you do? Do you take the loss and sell your holdings at a reduced price? Will you hold the coin and wait for a price recovery? We never know what to expect when it comes to cryptocurrency. Maybe the coin may never hit its all-time high again, but all this could be avoided if you have a robust contingency plan. Every choice you make will have a consequence. If you sell all your assets or a small portion when the price rises, you will profit significantly. On the other hand, if you hold on to your coin holdings when there's a price reduction in anticipation of a price recovery, you can incur massive losses. That's why you need to have an exit strategy. What do you need to do? Here are some of the most popular exit strategies. Limit orders. What does this mean? Have you invested in any cryptocurrency? Limit orders means that you can prematurely decide that your stock will automatically be sold or bought at a specific price point. This helps you limit the loss or profit at a price range you're willing to accept. Does this make sense to you? Let's look at a practical example. Let's say you've bought $100 of Bitcoin at $25,000 and would like to sell that Bitcoin once the price hits $20,000. What do you think you should do? You can set a limit order to sell once the price hits $20,000. What does that mean for your stock? Well, it means that once the price hits $20,000, an order to sell the assets is added to the transaction book. The order remains until the limit set is reached or you decide to cancel the order. Does this sound like a good idea for you? The best thing about limit orders is that they're automatically executed even when you are asleep. This makes it convenient. Furthermore, a limit order is an excellent way to limit losses or take profits. The concept is you don't have to consistently check your investment portfolio as you wait for the right price to sell off your assets. That's because you already know how far you can go with the losses and the profits that you're willing to accept. However, there's one risk involved when it comes to limit orders. Sometimes, where there is an extreme price fluctuation, the order might not get filled in time. Nonetheless, risks are a part of investments. Setting a limit order is a great idea to protect your assets. Do you think it's something you'd consider? Maybe you should if you haven't done so yet. Another great strategy is the step-by-step method. Every investment requires a plan. It's advisable not to invest blindly. Think about when the results will satisfy you. Does a 20% price increment satisfy you? Or do you want 200% profit before you start thinking about selling? The step-by-step method helps you know your limits. It allows you to sell a predetermined percentage of your stocks at specific price points. Success is not definitive, and there's no formula to achieve it. This strategy prevents you from being greedy or selling late. At the same time, you'll be getting profits once the predetermined price point is reached. Many investors always hold on to 5 to 10% of their stock for a longer time in anticipation of a bigger upcycle or just because they believe in the project that they're investing in. Taking profits at specific price points is a smart move. Do you think the step-by-step method's a strategy you'd consider? Let's look at this practical example. If the price hits $25,000, you sell 10%. If the price hits $35,000, you sell 10%. If the price hits $50,000, you sell another 20%. If the price hits $80,000, you sell 20%. If the price hits $100,000, you sell 20%. If the price hits $155,000, you sell 10%. The example is a clear outline of how the step-by-step method works. The last strategy we'll discuss today is initial investment return. In this particular case, you take profits equal to the amount you invested. Let's say you invest $1,000 at a later point in time. The profit equals the investment amount. You take it as it is. This is a great way to reduce the risk of losing money. The objective is to avoid losing more money than you originally invested. This is a simple but smart strategy used by some investors. That's all we have prepared for you today. Once again, many thanks for tuning in to Stacking Stocks Today. Don't forget to like, share, and subscribe.